Good morning, good afternoon, everyone. Welcome to a brand new video. It's Ankit again. Today I want to make a video about how to invest your first $1,000 in the stock market. You can mix and match, diversify doing this method. It doesn't have to be this way, where you allocate a certain percentage to certain sections that you want to put your money towards. Or you might believe in a company that, more than this company. So these are all things to consider. Make sure you always do your research. This is not financial advice. This is just a suggestion for how you should invest your first $1,000. If you're excited about today's video, then drop a like and subscribe. It really does help out and support everything I'm doing. Leave a comment with what you would invest in if you had $1,000 and you're just starting in the stock market in the comments below. And let's see how different we are and why you chose what you chose. Subscribe if you're new for weekly videos on investing, health, and life. Let's try to hit 7,000 subscribers. With all that out of the way, let's get into today's video. If you had $1,000 to invest right now, 40% of it should be allocated to index funds and ETFs. So here's a few ETFs and index funds that you might want to consider for that 40% of your $1,000 that you're looking to invest. First off, we have SPY, S-P-Y, the S&P 500 ETF. And as you can see, 5 years it's up 92%. And 1 year it's up 11.46%. Next up, we have Vanguard 500 Index Fund ETF, VOOO. Over the year, it's up 11.47. Over the 5 years, it's up 92.82. Next, we have QQQ, and which is up in the past year 9.3%. And over the 5 years, it's up 174.19%. Another ETF you can look at is ARK Innovation ETF, Kathy Wood's ARK, ETF. And if you click on here, you can see more information about it. The holdings right here. If you click on it, it'll scroll you down to it and all the holdings that are worth in this ETF. So make sure you always do your research on all these different ETFs I just named before you go and invest in them. And find one that you really like, that has companies that you really like and you know about. Another great ETF is INRG, which is the Clean Energy ETF. And year to date, it is down 3.19%. Over the 5 years, when you zoom out, you can see it's up 140%, which is amazing. And you could always go to other websites and find out what the current holdings are if you wanted to. Next you should have 25% of that 1,000 into blue chip stocks. And if you search blue chip stocks, it will give you a list right here. And you can just scroll all the way to the right. You can see all the different companies. Some of these might not be available depending on where you're living. And then some of them might be available where you're living. So these are different companies that you should look into. And these are the blue chip stocks. Here's a list of some of the blue chip stocks that you might know of or you might use on a daily basis, like 3M. You might see a lot of their products at your work. Lockheed Martin, Procter & Gamble, when you go shopping, you could probably see a whole bunch of their products. MasterCard, if you have a MasterCard. JP Morgan Chase, Walmart, Microsoft, Caterpillar, United Health Group, Starbucks, if you go to Starbucks. Cisco products all over. When you go to work, you'll probably seen a whole bunch of Cisco products. Boeing, McDonald's, Home Depot, Verizon, Intel, Goldman Sachs. How can you identify a blue chip stock? Here's 10 characteristics you can identify blue chip stocks with. Large market cap, consistent earnings growth, high dividend payouts, low debt to equity ratio, strong finance, PE, PEG, PB, ROE, strong balance sheets, stable cash flow, low volatility, brand credibility, good weightage, and index. So what is a blue chip dividend growth company? One, they have to be large and reliable. Blue chip dividend growth companies tend to be large, well-established corporations with solid financial fundamentals. So here's some companies on the screen that are considered some amazing blue chip companies, with most of them paying out dividends below, if not all of them. History has shown that blue chip dividend growth companies tend to have a proven track record of increasing its annual dividends year after year. It is resilient to economic downturns. Though not guaranteed, blue chip dividend growth companies are perceived to weather economic downturns while protecting its dividends. And it gets its blue chip name because of poker analogy. The term blue chip comes from poker, where a blue chip is typically the highest value of all the chips. And the next 25% should go into FANG stocks, such as Facebook, Apple, Amazon, Netflix, Google, Tesla, Microsoft. So these are all, companies that are known to do really, really well, and you probably wouldn't have to worry about, even Netflix. And these are all companies that are, moats and currently dominating their, individual sectors, and they're doing amazing things. And as you can see, here's the total return since March of 2009 for some of these companies that I just named. And the last 10% should go into companies that have a lot of growth potential, that you think are doing major things and amazing things towards the future of that company and towards the future for the world or human or whatever it might be that they're trying to accomplish. So you have companies like Airbnb, Robinhood, Snow, Shopify, Square, SoFi, Uber, companies like that.